The Fed's Secret Weapon: Understanding the Impact of Inflation and the CPI Report. Are you ready to uncover the Fed's hidden weapon in managing the economy? Get ready to delve into the world of inflation and the CPI report and discover how they play a crucial role in shaping your financial future. From the average household budget to the stock market, the impact of these factors cannot be overstated. So buckle up, make sure you hit the like and subscribe buttons really quick before we start, and join us on a journey to understand the Fed's secret weapon and the power it holds over your wallet. In today's complex and ever-changing economy, the Federal Reserve, or Fed, is a key player in controlling inflation. Inflation is a sustained increase in the general price level of goods and services in an economy over a period of time. The Fed closely monitors inflation levels by watching the Consumer Price Index, or CPI, report, which measures the average change over time in the prices paid by consumers for a market basket of consumer goods and services. The CPI report provides valuable information for the Fed's monetary policy decisions and helps ensure stability in the economy and promote growth. Understanding the role of the Federal Reserve and inflation is key to understanding the overall health of the nation. The Federal Reserve is the central banking system of the United States, established in 1913 with the goal of providing a stable and reliable source of financial power for the nation. The Fed has several key responsibilities, including controlling the nation's monetary policy and ensuring stability in the financial system. One of the many ways the Fed controls the nation's monetary policy is through the manipulation of interest rates. By increasing or decreasing interest rates, the Fed can influence the amount of money available in the economy, which in turn affects the economic growth and inflation. In addition to controlling interest rates, the Fed serves as a lender of last resort, providing emergency loans to financial institutions during times of financial crisis. During such times, banks and other financial institutions can turn to the Fed for these emergency loans, which help to stabilize the financial system and prevent a widespread panic. One notable example occurred during the 2008 financial crisis when the Fed loaned $85 billion to insurance company AIG to help to avoid collapse. Without this loan, the financial system may have suffered a catastrophic failure. This action by the Fed helped to stabilize the financial system and prevent a widespread panic. In addition to serving as a lender of last resort, the Federal Reserve also acts as a regulator of the banking system. It supervises and oversees banks and other financial institutions to ensure they are operating safely and soundly. One way it does this is by conducting regular stress tests to evaluate whether banks have enough capital to withstand a severe economic downturn. In 2019, the Fed found that all 18 of the largest banks in the US passed the stress test, indicating that they were able to weather an economic shock. Finally, the Federal Reserve has the power to control interest rates by adjusting the federal funds rate. Lowering the interest rates can help stimulate economic growth by encouraging borrowing and spending, while raising interest rates can help prevent inflation. One example of this occurred during the COVID-19 pandemic in 2020, when the Fed lowered the federal funds rate to near zero to help support the economy. This move helped to reduce borrowing costs for businesses and households, which in turn encouraged spending and investment. The Fed has also established new credit and liquidity facilities to support the flow of credit to households, businesses, and state and local governments in order to alleviate dislocations in financial markets that may exacerbate inflationary pressures. Over the past year, the Federal Reserve has taken several measures to address the issue of rising inflation. One of the main steps it has taken is to gradually reduce its asset purchases, which were initially implemented to support the economy during the pandemic. The Fed has indicated that it plans to continue reducing these purchases in a gradual and measured way until it sees substantial further progress towards its goal of maximum employment and price stability. In addition to scaling back asset purchases, the Federal Reserve has also been raising interest rates in an attempt to get inflation to its target level. The first rate hike in 2022 by the Federal Reserve took place in March, when the Fed approved a 0.25 percentage point rate hike at their meeting on March 15-16. This represented the first increase since December 2018. As of February 2023, the Federal Reserve has so far raised its benchmark interest rate by a quarter percentage point in its most recent policy decision. This rate hike has been the second one in 2023, with the previous hike occurring earlier in February of this year. Following the most recent rate hike, Jerome Powell, the Federal Reserve Chair, has stated that it's still too early to declare victory in the fight against inflation. Inflation has been a big concern for the Federal Reserve, with the most recent Consumer Price Index data released in January 2023 showing that prices for goods and services rose by 6.4% over the past 12 months. This was a slight decrease from the annual rate of 6.5% in December 2022. It is important to note that the Federal Reserve makes decisions on interest rate hikes based on a variety of economic indicators, including inflation, employment, and economic growth. Therefore, it is possible that future interest rate hikes may be adjusted depending on how these economic indicators evolve over time. Overall, the Federal Reserve has taken a cautious approach to fighting inflation, recognizing the importance of supporting the economic recovery while also taking steps to keep inflation in check. The actions it needs to take reflect its dual mandate to promote maximum employment while maintaining price stability. One of the biggest problems faced by many countries is overprinting money, which leads to inflation and a devaluation of the currency. When a central bank overprints money, it increases the supply of money in circulation, which in turn decreases the value of each unit of currency. This leads to an increase in prices, as the same amount of goods and services now cost more to buy because of the devaluation of the currency. The effects of overprinting money are far-reaching and can harm an economy in several ways. It erodes the purchasing power of the currency, as consumers have to pay more for the same goods and services. This can lead to a decline in the standard of living for citizens, as they are no longer able to buy as much with their money. In addition, overprinting money can lead to a decline in the savings and investments of individuals, as the value of their savings and investments decreases due to inflation. This can discourage people from saving and investing, which can lead to a slowdown in economic growth. Moreover, overprinting money can lead to an increase in interest rates as the central bank tries to counteract the effects of inflation. This can lead to a decline in borrowing, as consumers and businesses are less likely to take loans while interest rates are high. The relationship between overprinting money by the Federal Reserve and inflation is complex and a topic of debate. Federal Reserve Chairman Jerome Powell is of the opinion that inflation and the money supply are not connected, even with the recent quantitative easing giving way to an increase in the money supply. However, there are those who disagree and believe that overprinting money could lead to inflation. Inflation can be caused by various factors, such as increase in the demand for goods and services, a decrease in the supply of goods and services, or an increase in the cost of production. Inflation can have a significant impact on the economy, as it affects the purchasing power of consumers and businesses. When prices rise, consumers have less money to spend on goods and services, which can lead to decreased consumer spending and decreased economic growth. On the other hand, when prices fall, consumers have more money to spend, which can lead to increased economic activity. The Federal Reserve closely monitors inflation levels, as inflation is a key factor in determining the monetary policy that will be implemented. High inflation can result in decreased consumer spending and economic growth, and the Fed may respond by increasing interest rates to slow down economic growth and bring inflation back in line. On the other hand, low inflation can result in a sluggish economic activity, and the Fed may respond by decreasing interest rates to stimulate economic growth. The CPI report is released monthly by the Bureau of Labor Statistics, or BLS, and is used by the Fed to monitor inflation and adjust monetary policy accordingly. If the CPI shows that inflation is increasing beyond the Fed's target range, the Fed may choose to increase interest rates to slow down the economy and prevent further inflation. If the CPI shows that inflation is below the Fed's target rate, the Fed may choose to decrease interest rates to stimulate economic growth and increase inflation. The CPI is an important tool for the Fed, as it provides valuable information about how prices are changing over time and helps the Fed make informed decisions about monetary policy. The CPI also serves as an important benchmark for measuring the performance of the economy, as changes in the CPI can indicate changes in the overall health of the economy. However, there are some limitations and criticisms of the CPI. One major criticism is that it may not accurately reflect the spending patterns of all consumers, as it only measures the spending habits of urban consumers. This means that changes in the prices of goods and services that are not commonly purchased by urban consumers may not be fully captured by the index. Additionally, some critics argue that the CPI does not take into account the impact of changes in technology and quality improvements on the prices of goods and services. For example, the cost of computers and other electronics has decreased significantly over time, but the CPI may not fully reflect this decline in prices because it does not take into account the improvements in technology that have made these products more affordable. If people start buying more electric cars and fewer gas-powered cars, the CPI may not capture the effects of this shift on overall prices. A smartphone today is much more advanced and feature-rich than it was a decade ago, but the CPI treats them as the same product. This can lead to an overestimation of inflation because it does not reflect the improvements in quality. Another limitation is that the CPI assumes that consumers buy the same basket of goods and services every year. Consumers, however, may switch to cheaper alternatives if the price of some goods and services rise, which the CPI does not account for. This can lead to an overestimation of inflation if consumers are able to substitute lower-priced alternatives. Some critics have expressed concern that the CPI may be manipulated to understate the true inflation rate. This can have significant consequences, as the CPI is used to adjust government programs, such as Social Security and tax brackets, for inflation. Despite these limitations, the CPI remains an important tool for the Fed in controlling inflation and ensuring stability in the economy. By carefully monitoring the CPI and responding with appropriate monetary policy, the Fed can help maintain a healthy and growing economy. In conclusion, understanding the role of the Federal Reserve, inflation, and the CPI reports is essential for making informed financial decisions. The Fed plays a crucial role in controlling inflation and ensuring stability in the economy, and the CPI report provides valuable information for the Fed's monetary policy decisions. By staying informed about these factors and how they impact the economy, consumers and investors can make smart financial decisions and position themselves for long-term success. Check out this next video to get even more tools for your financial knowledge toolbox. Thanks for watching, and see you in the next video.